Today, we get into a topic which I think is far more important than all too many people realize, and particularly at the moment. And this is the difference between passive and active investing. So, hello and welcome back to our channel. Today's topic might sound a bit technical and boring, but I'd ask you to please bear with me, because I believe that understanding this topic is going to be really important for your ability to become wealthy in the years ahead. It's also really important for the societies we live in, as hyperbolic as that might sound, and I'm going to explain why this is over the course of our next few videos. I'm going to argue that the way that passive and active investing have been developing in recent decades is actually doing nothing less than threatening the foundations of our modern capitalistic system. It's having a hugely negative effect on the effective functioning of the economy in many modern democracies, and imperiling growth and innovation as a result, and particularly in the UK. It's also one of the key drivers of rising wealth inequality all over the world, as mad as that might sound. And as with so many of the topics I write about, and which we've covered on our channel, all of this really is incredibly poorly understood by the general population, but also even by a large number of professionals working in the finance industry, as I'm going to show. It's pretty clear that most of our politicians have absolutely no idea about this stuff either, which is less than ideal, given the impact this topic is having on things as important as growth and innovation, and on wealth inequality too, as I say. So today we're going to kick things off by explaining what these two things are. What do we actually mean by passive and active investing? Why do so few people really understand this stuff properly? And why is this so important for all of us in the years ahead? And by the way, if you think you understand this subject in some detail already, I'd encourage you to watch the next few videos regardless, because I'm pretty confident that much of the information I'll be sharing will very likely go some way beyond how most people understand this subject. And as I say, this stuff really is pretty important, and it's likely to get even more so in the months and years ahead for reasons we're going to come on to. So the first thing we need to do here to explain what this all means is to remind ourselves again what funds are, big picture. For the majority of private investors, funds are arguably the most relevant of investment vehicle. And this is quite simply because a fund allows you to own a large basket of many of the key financial asset classes. As an investor in a single fund, you can end up owning hundreds or even actually thousands of shares, for example. And in certain types of multi-asset fund, you can even end up owning a mixture of shares, bonds, property, and commodities in one place. The Dutch and British came up with the idea of funds in the 1700s and 1800s respectively, and they were invented for a very simple logical reason. One of the most important ideas in investment is something called diversification. This is simply the investor's version of not putting all your eggs in one basket, as I'm sure you're well aware. Early on in the creation of financial assets, and particularly shares, it was clear to anyone with common sense that splitting your money between several investments, between several different shares, would be inherently less risky than having all of your money in one investment. And this should make sense to you intuitively, and academic research has confirmed this reality many times in the centuries since. It was also the case that many early potential investors were excited about investing in more than just one business area or sector. Why restrict yourself to owning one company if you can invest in several companies and from lots of different industry sectors too? And similarly, why restrict yourself to assets from only one region of the world? By owning a wide variety of companies from a wide variety of countries and sectors, not only would you spread your risk, but you'd also give yourself exposure to many more exciting parts of the world economy. So lots of people with money to invest prefer to own a large number of shares in a large number of sectors and countries. The only problem with this, particularly back in the day, however, was that there was usually a reasonably large minimum investment required in order to buy any given share. And this meant that in the early days of the stock market, only very rich people were able to own a large number of shares and to be diversified as a result. Diversification simply wasn't an option for normal people, and investment funds were invented to solve this problem. The idea was simply to pool money from many investors, each of whom wanted to own a large cross-section of investments, and this large pool of money would then be able to invest in lots of different things. Back in the day, if 10,000 people invested an average of, say, £10,000 each, for example, you'd have a fund of £100 million. And this fund could then buy dozens or even hundreds of different shares, something almost all private investors would just not be able to do. In the UK, for example, the Foreign and Colonial Investment Trust, the oldest one in the country, was founded all the way back in 1868. And as they said at the time, it was designed to help the investor of moderate means have the same advantage as the large capitalist. Everyone who bought shares in that fund would then nominally or theoretically own a proportion of all of the shares owned by the fund, even if their individual investment in each share was far less than the minimum amount they would ordinarily have been permitted to own directly. This all seems like pretty basic common sense stuff to us 21st century geniuses, but it was actually a very clever and powerful innovation. The other advantage for investors was that the company offering that fund for sale would then take care of the huge administrative pain of owning dozens or even hundreds of shares, which was even bigger back then, with no internet, email and so on, than it is today, of course. As you can imagine, because of the many advantages in terms of diversification and administration that funds gave investors, the idea caught on. And today there are thousands of investment companies all over the world offering hundreds of thousands of different funds. So that is funds overall. In the last few decades, thanks to yet more innovation from the nasty old finance industry, two main categories of them have developed: active and passive. So let's look at these. Active funds are funds where an individual, known as a fund manager, tries to use his or her skill to pick the best investments, such as shares or other assets such as bonds, real estate or commodities, to make the best return possible for investors in that fund. And a fund of this type will usually be limited to investing in a certain type of asset class. For example, it might be a European equities fund, in which case the fund manager would be limited to buying shares in European companies. Or it might be a global bond fund, or a metals and mining fund, or any number of different things. As many of you will understand, given what a hot topic this has been in recent years, active funds cost more than passive funds, because you'll have to pay for the clever, well-paid fund manager, and usually a big team of analysts, office space, and lots else besides too, to invest in the right shares, bonds, or commodities, depending on what type of fund you purchase. Some fund managers are excellent and well worth this premium. However, there is a wealth of research that says that on average over the long run, passive funds outperform active funds after accounting for costs. We'll be looking at this reality in greater detail as I go through this video series, because there is rather more to the argument than meets the eye, as I will show. One reason you might not dismiss active funds entirely, particularly as you get older and wealthier, for example, is because there are certain investments you might want to make that can only really be done with an active fund for more or less intractable technical reasons. Again, this is a topic to which we will return. But as a general rule, particularly if you're just starting out and want to keep things simple and minimize your costs, you will very likely be best served by using passive funds. So let's look at what these are. Most passive funds tend to seek to copy the performance of something called an index. And as a result, these funds are sometimes referred to as tracker or index funds because they track an index. And arguably the most famous of these would be something which tracks the main US stock market index, the S&P 500. If you were to buy an S&P 500 tracker fund, that fund would aim to replicate the performance of the S&P 500 index of American shares as closely as possible. And if you were to invest in such a fund, your money would essentially be divided across the 500 shares in the S&P 500 index by the company providing you with that passive fund. As you might imagine, this is a far easier way for you to get exposure to that many shares as compared to trying to buy them yourself. You yourself would be pretty unlikely to buy all 500 stocks in the index unless you had a huge amount of money and a great deal of time. Passive funds are a cheaper way to invest than active funds and are a much easier and cheaper way to get exposure to a large number of shares or indeed anything else than buying those same shares individually, more or less obviously. To explain a bit more about how all this works, it's worth us looking in a little bit more detail at what an index is. An index is simply a method of measuring a stock market in some way, or indeed any other financial market. And the plural of index is indices, by the way, for what it's worth and to avoid any confusion. The S&P 500 is an index, and it's just an invention of a company called S&P Global. They add up the price and size of the biggest 500 companies listed on a stock market in the US, and the number that results is then known as the level of the S&P 500. The point of this is to give investors all over the world a rough snapshot of how well the US stock market is doing, and to a certain extent, how well the American economy is doing by extension. The S&P 500 does not represent the entire US economy, but it is a good proxy since the top 500 stock market listed companies represent a very large percentage of the entire value of the stock market, and the activities of those companies represent a large percentage of the value of the US economy as a whole too. Even the enormous S&P 500 index does not tell the whole story about the economy though, because there are thousands of other smaller stock market listed companies, as well as millions more private companies operating in the US, and that is companies that are not listed on a stock market. Every country in the world that has a stock market has several stock market indices. These were originally created and managed by the companies in charge of those stock markets, like the London Stock Exchange in the UK or Deutsche Börse in Germany. And indices you may have heard of include the Dow Jones, Nasdaq, and S&P 500 in the US, the Nikkei in Japan, the Hang Seng in Hong Kong, the DAX in Germany, the CAC in France, the ASX in Australia, and so on. It's important to understand that indices are somewhat arbitrary constructs. Each national stock exchange chooses to include different numbers of shares in their main index and then cuts their market up in a variety of different ways too, providing other additional indices for an investor to look at. In the US, besides the S&P 500, there is also the Russell 2000, for example, which includes 2,000 smaller stock market listed companies. In the UK, there's the FTSE 100 of the 100 biggest British companies, and the FTSE 250, which includes the next 250 companies in terms of size. And together, these make up the FTSE 350, more or less, obviously. Despite being arbitrary, indices are very useful to us as investors, and particularly nowadays. Because if you want to make sure that you have financial exposure to 500 of the biggest and most important companies in the US, or the 100 biggest companies in the UK, you need look no further than the S&P 500 or the FTSE 100 indices. In recent years, independent financial information firms such as Reuters and Bloomberg have created their own indices for a wide variety of assets, as have certain divisions of big investment banks like Morgan Stanley, Barclays, and Goldman Sachs. And crucially, what this means is that you can now find indices for pretty much any asset or country in the world. Bonds, commodities, big companies, small companies, and stock market sectors such as banks, telecoms, or pharmaceutical companies. The reason this is important for our purposes is that as a private investor, you're generally able to buy these indices using a related fund. And these are what passive funds are. There are various kinds of legal structures for such funds depending on where you're based in the world, but the most common of them are called exchange-traded funds, or ETFs for short. Today, it's possible to invest in pretty much anything at all that you can think of using a passive ETF. And for many people, such products are a great way to go, certainly when you're just starting out, and I've covered this all in some detail throughout this video series. That said, there is a great deal more to understand about this subject. In our next videos, we're going to look in more detail at the respective merits of passive versus active, and at why active funds may be rather more important for all of us than all too many people realize, including a good number of industry professionals. We're also going to look at companies like BlackRock and Vanguard that you may have heard of. Both of these companies are incredibly misunderstood, and there is an enormous amount of ignorant nonsense posted about them by people who literally don't understand what they are in any detailed way. And I'd repeat that all of this stuff is really important in order for us to understand topics such as growth and innovation in our economies, and also why wealth inequality has been on the rise. So, if you care about such things, please do watch out for our next videos in this series. And that's it for today, but as ever, if you want to ensure that you're one of the first to see these videos when they're published, please do click the subscribe and bell buttons. Do add any comments and or shout with any questions and even suggestions for future topics. And please do also think about subscribing to our free email service from the Plain English Finance website. And if you'd like to hear from me more regularly, if you can stand it, please do feel free to connect with me on any or indeed all of LinkedIn, Facebook, and X. Until next time, I wish you and yours the very best.